This lesson is going to discuss another case study, which is that of Argentina in 2001, which saw the Argentine economy collapse and the currency devalue threefold. And Argentina defaulted on its sovereign debt, and it was one of the largest defaults in history. Now, what we're going to do is understand what were the dynamics in the Argentine economy that created these vulnerabilities. And a typical balance of payments has certain telltale signs, which Argentina displayed many of them. So, in the case of Argentina, for example, we saw lots of them, and these include, for example, an overvalued exchange rate, and that typically leads to current account deficits. Because the country has current account deficits, it needs to be financed. The balance of payments needs to be financed somehow, and usually it's either foreign direct investment or hot money inflows into the equity market or to the bond market. And in Argentina's case, it was hot money into both the equity and the bond market. Then we also saw potential for rising debt, either consumer, corporate, or government debt. In the case of Argentina, it was all three. We also noticed that countries which have flat or falling reserves typically will see another vulnerability rise, and the reason why they're flat or falling is because the balance of payments situation is deteriorating, either because their trade account is weaker or investors are taking their money out. We also see vulnerabilities in terms of a mismatch on the balance sheet, and that's either a currency mismatch or a maturity mismatch in terms of their debt. Also, the erosion of policy credibility and poor regulation, and this typically is associated with investors pulling their money out, because when uncertainty rises or there's an erosion of policy credibility, investors have less confidence in that particular economy and will take their money out. And then lastly, some form of panic or shock, and this can be domestic or foreign. In the case of Argentina, it had an overvalued exchange rate, so it adopted a fixed exchange rate, 1 peso equaled $1, but because inflation in Argentina was much higher than in the US, this meant that in real terms the currency appreciated. And this led to a loss of competitiveness, and it made Argentine goods very expensive. At the same time, because exports were expensive, because your currency has appreciated, your imports are much cheaper, and so they increase relative to their exports, and it causes a huge current account deficit. So the overvalued currency resulted in trade and current account deficit, and that was posing external weaknesses for the economy. The current account deficit was 3.1% of GDP, which is quite large, and it was driven by a trade deficit of about $2.4 billion. So in order to cover that current account deficit, there had to be inflows into the financial account, and it can either be foreign direct investment or hot money flows. In the case of Argentina, there was a lot of hot money inflows. So between the period of 1990 to 93, foreign capital was predominantly in the form of portfolio investment, and in 1998, portfolio investment accounted for about $10.7 billion. And the problem was that as financial markets perceptions change of Argentina, their understanding of the Argentine economy become more vulnerable, it became unstable, they started to withdraw their capital. And by 2000, portfolio investments in Argentina dropped, and they actually fell by 1.3 billion US dollars. So money was leaving. At the same time, there was a lot of rising debt in Argentina. So because they had a current account deficits and fiscal deficits, and the government was running fiscal deficits, that led to a rise in debt. And that was made worse by the privatization of the social security system. So by 2000, total government debt was 45% of GDP. And also the social security privatization made the government lose a lot of revenue, increasing government borrowing. So government debt continued to rise. And the more debt you have, the more risk of a crisis you typically have, because it's a sovereign crisis. So the next was falling reserves. So investors started pulling their money out in anticipation of a devaluation. And what happened was both the current account and the financial account flipped into deficit, which meant that reserves started falling sharply. So reserves fell from about 25 billion in 2000 to 10.5 in 2002. And what that meant was that the external buffer that Argentina had in terms of its dollar reserves with which it could defend its currency completely evaporated. So as Argentina had a lot of capital inflows into its equity market, and it was also dependent on the sovereign bond market, which meant a lot of investors were investing in its bond market. So all of these inflows were both in equity markets and the bond market. So as soon as that money started coming out, it was very difficult for the government to finance itself. There was also a mismatch on the balance sheet. So in the case of Argentina, there was a mismatch in terms of currency, but also maturity. So because the currency board in place had a fixed exchange rate of 1 peso to $1, most of Argentina's debt was denominated in dollars. And that created a huge currency mismatch once the devaluation occurred. Because if debt was about 45% of GDP, as soon as they devalued, let's say by 30%, then all your debt becomes 30% more expensive. So that's your currency mismatch. At the same time, although Argentina had lots of long maturity debt, as in it didn't have many short-term obligations, the fact that it had to use the little reserves it had in order to back the currency in circulation, it meant that those reserves were essentially blocked off. And what that meant is that when it needed to refinance a small portion of its debt, it couldn't. So basically, it had both a maturity mismatch and a currency mismatch. There was also a lot of policy credibility which was eroded. So heightened political risk contributed to weakening consumer confidence, but also private investment and businesses decided, it's very uncertain times, we don't want to invest so much, consumers were worried, they didn't want to spend so much. So this was caused by President Menem's attempt to run for a third term despite a constitutional prohibition. And whenever that typically happens, and a president tries to run for a term where they're not supposed to, investors become very wary because it's politicians trying to stay in power, and they're not appreciating kind of the democratic institutions, and they're trying to change them, which isn't very good. Also, there are high levels of corruption and sociological divisions within the economy, which caused consumers and people to be unhappy. So a little bit of rise in political unrest, and of course there was civil unrest because of social movements. And I think the weakening of the political system caused a few tensions within the government, within the different parties, and it caused for political uncertainty. And actually, when you have weakening of the government, it makes policy and reform drive much more difficult. So I think investors became very worried there. And lastly, Argentina also faced a form of shock or panic, but it wasn't a domestic shock or panic. It was actually one of its largest trading partners and a big competitor in the region, Brazil, devalued in 1999. And what occurred was Brazilian exports became much more competitive than Argentine exports. So Argentine exports were already becoming expensive because of the overvalued exchange rate. But then Brazil, one of its biggest competitors, and also one of the biggest consumers of its goods, devalued its currency, which meant that Brazil could now export to countries like the US and Europe more cheaply, so it stole market share from Argentina. But at the same time, Argentine exports to Brazil dropped because they were even more expensive. So all in all, Argentina showed very classic symptoms of a balance of payments crisis. And it's very predictable what happened. So hope this was helpful. And remember the different categories of vulnerabilities which we've looked over here.